Hey, you there? What's going on, Bubba? Yeah, I know it's weird. Hey, gamer glasses, man. They're not as nice as I would like. I kind of look like an old man. Oh, wait, I am an old man. Gotta drink your vegetables. All right. Guten Morgen. Who's ready to go? Gotta get the YouTube part going. All right, I'll mark that as the beginning. Good morning. Welcome to Forex.Today, the YouTube community of more than 21,000 foreign exchange traders. We gather here today to conduct technical and fundamental analysis with the overriding goal of planning our trades in advance because, well, trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. Guten Morgen. Yeah, it's kind of weird. I need a better set, huh? I need a better set. Hey, but you know what? They're gamer glasses. They protect your eyeballs. Yeah, very important. What do you think? Little British banker thing going? Yeah. Cool. Well, that's because the Council of Investment Advisors are meeting today at noon. Yes. We're going to decide how to take advantage or get out of the way of current market conditions. My name is Wayne McDonald. I love trading. I love investing. I love money. I love capital. It makes the world a better place. Oh, money is the root of all evil. No, it's not. So anyways, they're weird. I need a different style, huh? The glasses. It's kind of weird. But anywho, let me know how I can help. Technical, fundamental, psychological. It's all good. It's all fair game. You are the boss. I am a humble servant. I am here to serve you. So let me know how it can serve you best. We're going to use different resources today, most likely. Okay. First of all, you're going to need a broker. Most brokers are not very good. Yeah, pretty simple. If you're going to be a sustainable small institutional investor and trader, you're going to need good service providers. One service provider is someone to execute your trades. Most brokers don't even execute your trades into the global market. Your trades don't go to Goldman Sachs or JP Morgan or a billionaire in Malaysia. No, you just get thrown into the broker's dark pool. And they figure everybody in the pool eventually loses money. So your winning trade today is offset by someone's losing trade. But there's always going to be more losers than winners. And they keep all the money. And if they happen to get a half-decent trader that tends to be profitable more often than not, they just sort of hedge against the person. And if that person continues to be profitable, well, kind of like a casino, they'll find a reason to kick you out of the casino. Well, that's not cool, especially if you plan on being successful. You need a service provider with a symbiotic relationship. This is simple enough. You need an ECN with straight-through processing so that your trades are actually offset by somebody in the interbanking system. So the ECN I use is Trader's Way. I recommend them. You should check them out. Do your own due diligence. Hey, Wayne, I like your style. I like the way you trade. How do I learn that? Oh, you go to Investor Bootcamp. It's very, 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 very exclusive and very, very, very expensive. It's $88 a year to learn how to trade properly. Used to be $1,000, now is $88. I dropped it during COVID when people were in lockdown at home, and I thought, you know what? Instead of you trading out of boredom, you could use this time to sharpen your saw. So anyways, I dropped it to 88. I kept it. I will not promise you that it's going to be the same in the near future, meaning in the next 30 days, it might go up a lot or a little or none. I haven't made that decision yet, but all of this is already moved over to TRADARS. Today, we are going to do a live group where it doesn't matter if you're in the day trading group or if you're in the swing trading group. We are going to meet today, download the reports, and read them. I thought I might actually download ISM right now and go through ISM Services, and you can get an idea of the details that we can pick up. If you want to be in the top 1%, well, you should actually do the required work, and that's what we like to do on Tuesdays. Cool, so now you'll know how to trade. Great, you'll have proper techniques. Now what? Now you're going to need to know the fundamentals. QuantBox gives you the fundamentals, so you can organize your thoughts like this. Okay? Yeah, or like this. Or you can track capital flows in stocks. Not stocks like stock market, but how much are the institutions long or short a particular asset. We track central banks. We were laughing at QuantBox today during QuantBox Live because there are experts on TV that are explaining why the markets are crashing, and some of them are like, well, you know, the Bank of Japan surprised people by how much they raised interest rates, and that spooked the market, and blah, blah. We knew that months in advance when they were going to do it, but precisely 0.15%. I can also tell you when the Bank of Japan's going to raise again and by how much. Do you know how I know all this? They've already told us. So when these experts go on TV and they're trying to explain what happened, what they're explaining is they have no frickin' clue. Well, I have the data. We have more than a clue. We're already prepared. Okay? Has any guru out there in YouTube made 2,000 pips on one trade recently? There are so many opportunities. The answer should be yes. But I made 2,000 pips on a pound yen trade in less than 2 weeks. One trade, not 5 trades, not 10 trades. One. Well, I guess we kind of were prepared. Yeah. And here's another way to organize your thoughts. Everything bullish and why. Everything neutral and why. Everything bearish and why. And you're doing proper quantitative analysis of macroeconomic data and doing comparative analysis between economies. So what you do is logical. So imagine every trade you made was logical, thought out, planned, understandable. And you not only are you long or short, but you know exactly why. Well, that's how you're supposed to trade. And everybody else is the other 95%. Cool. Now, I've integrated that too into TRADARS. And TRADARS is going to provide you a platform like Bloomberg Terminal. A Bloomberg Terminal for small institutional investors. Anybody want to pay $2,200 a month for a research platform? No. Now, after 20 or 30 or 40 years, hey, you know what? That Bloomberg Terminal is powerful. It does really deep research. Does it provide coaching? No. Would you like a community? Would you like training videos? Would you like training sessions? Would you like performance coaching? Yeah. as well as the fundamentals and as well as the technicals. I don't think Bloomberg terminals do technicals. I think they have charts, but I don't think they do technicals. So TRADARS for you is the complete package. I'm going to have to log in from the back end, but I'll log in from the front end just for now. And it automates your technicals. Yeah. How cool is that? There's a radar for Forex, a radar for cryptos, radar for stocks, radar for commodities, radar for indices, and it does technical analysis, and it's showing you the patterns it sees and the next leg in the pattern. It doesn't give you signals, but you should know USD Mexican peso is in an up channel and you've already missed the dip. Well, that's you're late. Okay. Cool. Maybe you're not late. Maybe you hold it for an hour. Maybe you hold it for 2 hours. Maybe you hold it for 2 weeks. Well, that's your determination. It's just showing you the next leg in this particular pattern. It's not wrong. It's just maybe not the right trade. So like, for example, USDN short an hour ago. So if you look at these 15-minute candles, when you were up here, hey, you're in a down channel at resistance. Yeah, maybe you want to sell here. Do you want to, is this the target? No, that's just the next leg. So it can get down to 143, but then you might be in the business of selling lower highs and lower lows, and you might be short this for a week, a month, or an hour. Well, that's your determination, but that pattern is happening on that time frame, and that is how you trade that pattern properly. Now, when you look at the opposite, Aussie dollar, it's a down channel, and TRADARS is suggesting the next leg, the next wave, is up to resistance. So do you buy it? No, it's just telling you the next wave is up. So get ready. In the next probably 3-4 hours, you might have an opportunity to sell it down. So it's doing technical analysis. It's doing fundamental analysis. You have coaching and training and community all in one spot. It's better than Bloomberg in some ways. One way is it's not going to be 2,200 per month. It's not going to be 2,000 per month. It's not going to be 1,900 or 1,800. Nice, right? So here's my vision. You are going to have a trading platform and community that will help you build your small institutional trading and investing business, a sustainable business. Does anybody look at their trading like a business? Well, I can tell you when I started this gig, I was a venture capitalist, and before that, I was a high-tech entrepreneur. I look at everything like a business. Okay? And the goal here, what I mean by sustainable, is you don't like come and go, oh, you're profitable this month, and then you're not profitable the next month, and you're just kind of all over the place. No, no, no. You want to trade with low risk and consistent performance. And for that consistency, you're going to need data, not guesswork and not a little trick. Hey, anybody want to learn my new trading strategy? No. Okay. No, I don't want to learn your new trading strategy. Yeah. So anyways, this is how the world works. Okay. And when you're in QuantBox, the first thing we do is look at these risk gauges. Did you know that? So we're tracking volatility, the stock market, the yen, gold, short-term treasuries, long-term treasuries, the dollar, and the put-call ratio, which is over 1 billion options on all kinds of tradable assets in the financial markets. And you need to know this stuff. If you don't, you just don't know. And let me tell you, there are experts on TV right now that know way less than we do. And that is not an exaggeration. So once you know, and then you're listening to the experts on TV, you will find, oh my God, they don't know. Yeah, and that's shocking. Which means you need to take care of yourself. Cool. All right, let's take a look at the S&P. We broke this down. I don't know if we did it yesterday in this live stream or I did it in a live group or something, but we identified different levels of support which could prop up this move. Look how nice that one worked. So the two scenarios we're on today is that, okay, we resume course. And I will show you why that might be the case today. Cool. Okay, so you buy the dip. Now, a big up and then some version of this, we call that a dead cat bounce, meaning this market's dead. It's going to bounce, but there's no life in it. Oh, thank you. I did that in QuantBox. Okay, cool. All right, so we don't know that. We don't know the future, right? Cool. But the nice thing is we had that. Now, if you zoom in on the daily 5, I think this price area we just touched is a key price, because this might be where the 5 EMA is tomorrow, and we might be back down here. And that would be the sign of the dead cat bounce, where we bounced for a few hours and then blah. And all it is kicking it off the 5. Is that going to happen? I really don't know. So you have to prepare for these scenarios. Now let's go a little fundamental. Are you guys okay with that? You want to do something that probably your average YouTube guru just doesn't even know how to do? Yeah, let's do it. All right. We will actually go into yesterday's PMI and say, okay, how does this fit in the previous narrative of the SOM taking us down into recession? That was triggered on Friday. I explained it yesterday in great detail. So, why maybe a recovery today? Why? It doesn't matter what. Don't bet. Don't just buy something because you think it'll go up. Okay, let's take a look at, I said if ISM Services came out at 49.9 or lower, it's going to be insult to injury, fuel to the fire. And yesterday was a -3 day, but it could have been a -5 day if this came out 49.9. So, your average guru probably pays attention to this, and they know things like, okay, it's 70% of the market, and then they're done. Well, let's evaluate this. Let's not just look at the headline number. Let's break it down into digestible pieces and use this report to actually figure out what is going on in the service sector. All right. So here's the headline number, and we were at 48.8. That's bad. Now we popped up to 51.4. Now we expected it to be 51, but 51.4 is better. But there's more to it than that. It was contracting and now it's growing. That is anti-recessionary. So it doesn't fit the SOM rule or the model. On top of this, we also know we have a 2.8% GDP in the United States. Well, you know, that's a massive GDP. That doesn't signal contraction, but it's also backward looking, so we don't know if we're contracting now. But it doesn't quite fit into the narrative of we are already in recession. And a growing ISM Services also does not signal that we're in recession. What about new orders? Yeah, we're getting new orders. Productivity growing, very big number. So, but it was a bad number. Now it's growing again. Okay, well, that would point to a higher GDP in the future. Also not contractionary. Now, looking at the employment subcomponent, it was 46. That was terrible, terrible, terrible. Boom! Big number. It's growing again. So far we have growing, growing, growing. Yeah. Inventories are contracting. That's also good. You kind of want to see that, because that means, well, you're going to need to build up your inventories, which is future productivity. Okay? So actually, when you break this down, that's kind of the important part. Employment. Can you have a recession if companies are adding jobs? Probably not. Okay? Are you in a recession if you're getting new orders? Probably not. Are you in a recession when everybody's busy doing stuff? Probably not. Okay? So it's not just the headline. It's like, why is the headline the headline? Notice it was bad, 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 bad. Well, this is some of the stuff that the Fed was probably looking at and like, oh yeah, we're going to need to cut. And then you look at this, and you're like, well, maybe we don't need to cut. So we might have this narrative of like, oh my God, the Fed's going to cut in September, right? And then it's like, oh my God, there's going to be a surprise meeting. They're just going to jump out and save everybody because the stock market is down 10%. Oh, dude, really? Sounds very emotional. And then the very next day we come out and you're like, okay, well, yes, panic is necessary if we're printing 46 and 47. That's really bad numbers. And if they came in low, that would be the fuel to the fire. Yes, if employment was anywhere near 46, even 48, but 45, 44, you're like, oh yeah, okay, layoffs are starting to happen. They're laying, instead of hiring people slowly, they're actually laying people off, and we're starting a trend in contraction and all that kind of stuff. And oh yeah, that would be like, this would be the evidence that yes, indeed, we're actually in a recession right now. But this was contradictory to that. So now we have a psalm that says recession. But this is the stuff that creates inflation. This is the stuff that creates non-farm payrolls. Okay? And so this is all future looking. This is what I'm talking about, is we're looking at how this will probably impact future numbers of inflation, future non-farm payrolls. How many central bank cuts are we going to get from the Fed? So, for example, we're at, let's say, 5.25, and inflation is at 3. These are rough numbers, right? And what is the normal spread between inflation and the Fed funds rate? And you could argue, like, let's say it's 4.25. Okay, let's just make that the argument. That would be normal. This is reality. The Fed cutting in a good economy is simply normalization. So it's less restrictive, but it's still restrictive. Okay, now, if they cut, and inflation stayed at 3, but they cut to 2.5, that would be not restrictive. That would be accommodative. But we're not going to go there, because that would be very inflationary, usually. So right now, how many cuts are coming? If the economy was crashing, they might want to lower it below inflation. But we're not there yet, I don't think. Okay? And not according to this, quantitatively speaking, this kind of stuff. Okay? But look at prices. Okay? So you have inflation. Inflation is still very high. Okay? Inflation is still very high. Now, Richard says it's 3 to 4 being priced in, right, by the end of the year. Okay, that's probably true. Is it correct? Because one of the things you will learn from me, and I did this heavy in the beginning of the year when 6 cuts were priced in, and I did a 2-hour presentation why that cannot be supported by any facts. That's how people feel. That's what people think. But all of that is opinion or bias. When you looked at the data back then, and I went through probably 25 different data points. I'm like, there's no 6 cuts, maybe 3, and that was in January. And so now we're back to like from 2 to 3 or 4. Okay, that's what's being priced in. But don't forget, they're not infallible. They're probably wrong. And when you look at this, okay, we're expanding again. So you don't need to rush. Meanwhile, inflation is not fixed. It's actually growing faster. Okay? Prices are still going up and have been going up a little bit every month for 86 months. Dude, 86 months. And it's picking up, not slowing down. So you could say, okay, they're pricing in 3 or 4, but that's really unrealistic. Oh, but the stock market is down. Well, it's supposed to be down. Richard says, I think it all happened Friday after. Well, we know when it happened. And we know why it happened. But once again, that's people's guesses and feelings and hopes. But that's not how I trade and invest. Okay? Interesting. So we do this kind of stuff every Tuesday. Today's Tuesday. So I will be going through all the, stuff like this where we actually download and read the reports. Okay. Okay. So the fear, Richard, was that we missed on NFP and that would create a new trend of, because we had, let's just look at it. It's a negative trend, right? So anyway, so we go to fundamentals, we go to employment, and we go to non-farm payrolls. All right. So it came out 114. We thought 176. Is that why? Partially. What about the last 3 months before that? Revised down, revised down, revised down. So we're about 150,000 less jobs over the last 3 months than what was initially reported. Well, that's a whole NFP. We've lost a whole NFP just on revisions. Another part is the trend is down. In particular, we got a 272 revised down. Then we got this sucker, 206 revised down. And now we're at 114. So we went from 3 to 2 to 1. So the rate of change is dramatic. Okay? 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 Well, there are many revisions. But anywho. Okay? So those are all the different things in play. Sure. Gotcha. But, we looked at this today in QuantBox. Let me just show you. If you want to be smart money, let me just show you. Okay. Volatility went up. Okay. Recently, in the last couple of weeks, volatility went up very significantly. Shocked a lot of people. Well, you can see typically between June and July, you get an uptick in volatility. Between July and August, you get a sharp uptick in volatility. So that's the 20-year and the 10-year. Sorry, 20-year and 5-year averages. It's usual. It's normal. And volatility is up, and people are shocked. But you're like, yeah, but we know it happens this time of year. So why would you be shocked? Oh, well, you don't know. Now, here's the thing. You ready? Week 32 and week 31, okay, is a dramatic increase in volatility. So this is general. Week 31 and week 32. Did you know week 31 was last week and week 32 is this week? Did we have a massive increase in volatility? Massive. In fact, I can get you the exact data. And it went up week over week. There was a 46% increase in volatility. And month over month, okay, a 61%. And we knew which weeks they were likely to happen. Oh. And then you get experts on TV and they're like, this was unpredictable. This is crazy. It's the end of the world. The Fed needs to save us. I'm like, you're just screaming because you don't know. And it's frightening. Well, I'd hate to be that investor. Okay, how terrifying would that be? Well, I wouldn't want to be that person. Yeah. So, anyways, we're bouncing between dynamic resistance and old mediocre support. Okay. Could be a rally today. I suspect a dead cat bounce. What if? All right. So, some of you guys ask, so what do you do in your routines and all that? And, I'm always on. But I'll tell you what I was doing today, this morning. At 5 a.m., 6 a.m. All right. This didn't translate, which is interesting. Continue. Okay. Oh, it did translate. Okay. This is what I was reading this morning. Now, it's not part of the typical fundamental analysis that you do. You probably can't even trade the Brazilian real, or otherwise known as the hey-hi. But it's a central bank. It's their recent meeting minutes, and it's beautifully written. Do you ever read their reports? Beautifully written. Yeah. And I do know a hedge fund that trades BRL, so I pinged them. I'm like, hey, did you read this? There's some interesting tidbits in here that could affect your trading. Are you aware of them? A little heads up. Okay? Oh, congratulations. So you read the RBA one. That's good. But again, it's sort of like, Wayne, how, what is your process? What do you do? Like, I do stuff like this without stop. There isn't like an exact process in that case. I'm always on. Does anyone want to read this? It's very informative. They go over their local economy, but they go over emerging markets. They go over mature markets like the United States and Europe, and they have different scenarios and risk analysis. It's gorgeous. Now you can read their discussion of what monetary policy has been, how it's worked, how it hasn't worked, how things could change, and things that are on their mind. Then they actually have their policy. So we run at the CIA, we run our meetings just like these guys. Yeah. Nobody wants to read it, huh? Okay. Copy it just in case. Okay. But that's how the Wayne do. Let's take a look at the indices. We'll do the long term first. Okay, we'll do the long term first. Dollar is ripper weak but bouncing. Very, very interesting. Like I've mentioned before, that's not typical, so something unusual is happening. Massive yen strength. Very cool. I've been coaching you on grabbing that. I hope you have. Commodity currencies have been weak for a long time. So selling Aussie, selling CAD, selling Kiwi has likely been the cornerstone of your trading for a month. The interesting thing is, what if you're not? What if you're not been doing that? What if you're just been doing euro dollar? Because that would be a dumb trade. When you just look at this, you're like, that doesn't make any sense. Okay? Okay? What is my advice on private equity stocks? I don't know. If you can't get to it, then don't have an opinion. Okay, but look, I hope you're using these tools. So everybody gets these templates at Investor Bootcamp. It's included with the $88. Okay, and you're like, oh, I don't use these. Then what is your process? Wait, you're not even doing analysis before you pull up your charts? Now you say, well, Wayne, these are longer term. I'm stuck on a 15-minute chart. Well, then you'd look at these, right? Okay. All right. Fine. Okay. Fine. But I'd like to start on the other ones first, you know? Yeah. So would euro dollar be good? And see, when you only look at small term trade, right? You might find something to do. Okay. Now look at this. Euro dollar straight up like a rocket ship. But we identified a long time ago that there's no trend. And so it went from the middle to the up. Now, again, okay, you might say, well, I made a lot of money trading that. Well, you bought in the middle of the range and against the normal pattern. And on top of that, usually in these market conditions, the dollar gets strong. So you're like, it's not a good trade. Even if you made money, it makes no sense. Now, maybe it comes through and it breaks and all that, but it hasn't done it. So what's really happening? Is it euro dollar? No. Okay. But is it USD yen? Yeah, more likely. Okay. Dollar's weak. And people were long USD yen as a carry trade for a very, very long time. And we have now fallen to a price on the charts that every trader in the world sees. Of course, if you're on a 15-minute chart, you don't see it. And, well, how accurate is it? Well, let's take a look. Here's the bottom of the wick. Okay? Cool. Now, that's support. On the flip side, we have a downtrend. And how do you trade downtrends? Okay, well, the 5 EMA is in control. So there's only 2 prices that matter in the world right now, that price and that price. Amateurs trade in the middle, and they wonder why they're inconsistent. See, if you sold here now, you're in the middle, but you're also on the monthly support pivot. So there's like, if you're only trading it now, what happens is there's a 50% chance of that, let's say. I don't know if it's really 50-50, because there's still going to be more likely pressure in the direction of the trend. So you don't know if it's doing pink or green. So the rest now is luck. Okay. Now, Don's like, yeah, well, we're not sure if this, that, or the other thing. And that is true, but you have to understand where you are in the process. So even if you're heading down here, the reason we have these colors on our charts is you're supposed to respect that, and you're supposed to respect that. And you can see by the wicks, there are traders that respect these things. What I'm saying is everyone else is in the middle, and that's why they don't make money, or they don't make consistent money. Okay, you need to know that price in advance, and you need to know that price in advance. Okay. Now, for me to go long, I would need a much different scenario. I see this was respected, then I see that was respected. I would need this to retest, and then I'd need something like this, or even better, something like this. But even, and here's a little trader's hack for you. Usually in a situation like this, you get the up, and, oh, it's reversed, right? No, then it's down, and then it's up again, and then it's down, and then it's up, and then it's down. And you need a double bottom of a double bottom, because that just is a double bottom on a higher time frame. And you're like, but we're on daily. Yeah, well, institutional traders consider that scalping. And you consider it swing trading or position trading. You consider that long term. And other institutional traders, they base everything on the weekly and then catch a day trade up. Okay? So they might scalp it up here and swing it up here. Okay? Because for them, this double bottom is a one touch. And one touches are not reversals. You need 2 or more touches, right? So, but on what time frame? Now, if you've missed this, you missed, okay, price support or market support. I call it market support. Okay, you missed market support on the old price. You missed market support, okay, so we'll call this price. You missed it on the weekly, and you missed market support on the monthly. Now, here's the wake-up call. If you've missed any or all of those, you're not doing it right. And you should recognize it. You shouldn't get emotional or all upset in a way you're like, how dare you talk to me, Wayne? Okay, whoa, just settle down, bro. Clearly, what I'm trying to tell you is clearly based on that wick and clearly by this wick, other people did see it. And they analyzed it and they took trades on it. They either took profit, or most likely they took profit and then shorted again. I'm trying to get you so that you can understand how everyone else is setting up their trades and be ready, willing, and able to assist them in their needs. Okay? But if you've missed all that, you need to recognize you don't know how these other traders are trading. And so what you should say is, well, how is it that you do trade? And, you know, maybe some kid on YouTube taught you how to scalp a 1-minute chart and whatever, bro. This is what institutions do. This is what pros do. And if you know that, you can do any strategy. But if you don't know that, Ben, nothing's going to save you. You're just sort of the monkey in the middle. Okay. Was that too brutal? Was that a bitch slap? I did want to make the point, and I did want you to hear me. But I have no intention of insulting you. Okay? Okay. Okay. In particular to those that just are not doing even this basic level of work of like, where's the next level of support? Right? If you're not doing that, like, oh my goodness. Oh my goodness. We need to erase everything and start over from scratch, right? Good morning, Ron. All right, so that's a key price. Don't you stink? Yeah. The other thing is we're already done August. How do you feel about that emotionally? Yeah, could be important, huh? Cool. All right. Maybe, right, JP? That would be part of your analysis, right? You'd use technical analysis to confirm or deny that hypothesis. Okay. What do you think of this trade? Up, 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 down, down. And we have plan A and plan B. Both were triggered. And there's our target. How do you feel about that? How do I get these? I guess this one's cleaner, right? Okay, you go to investorbootcamp.com. Okay, you pay the $88. Okay, that gets you 100 hours of lectures. Not Babel videos, lectures. And there's also unlocked the chart toolkit for MT4, MT5. You have the basic toolkit installer, so you run that. And then you go to the complete and you run that. And inside the complete, you get the currency index creator. Whoa, 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 whoa. Right? It might actually be the indexer that does it. Okay? And then it installs this, but then it installs a template that then takes this tool and builds those for you. All you need to know is you download that and install it, you download that and install it. Okay? Installs all 200 plus files in the right folders in 14 seconds or less. Yeah, very cool. What do you stink? It's pretty good, huh? Yeah. Yeah. The other thing is some people paid $150 for that. Yeah. Easy peasy lemon squeezy. Yeah. Yeah. Okay. All right. All right. Yeah. Sure. Okay. So what do you think? Should you sell off the 4-hour 21? Yeah, that's what I teach. Is it going to go farther down? I don't know. Okay. Okay. Yeah. Wouldn't that be good to know? Yeah. The target is 149 on pound yen. We're at 183. So people that say it's too late may not have an ability to make a judgment call if it's actually too late or not. Is it too late? Oh, I don't know. But if you thought it could fall another 3,500 pips, it would change your perspective, wouldn't it? Okay. Yeah, well, Robin, that's how you use PPI. The other thing about PPI that is alarming, Robin, is that 70% of all the improvement in inflation over the last several months is completely contributed to falling oil prices. Not monetary policy working, not any problem being fixed. Which means if oil prices go back up, there's going to be a huge impact on inflation going up again. And the Fed can't do anything about that. So when the government is cheering that they fixed inflation and the central bank is cheering that they fixed inflation, let me just tell you, if you read the PPI, you know they haven't fixed anything. Okay? Causation and correlation, like I talked about today in QuantBox, it's the opposite. Let's say ice cream prices were too high, Robin. Last summer, ice cream prices were ridiculously high. But last year was very hot. Okay, so it's a problem. So over the period of September, October, November, December, January, February, and March, ice cream prices have fallen. So the problem's been fixed, right, Robin? Oh, well, it must have been the government. Oh, it must have been the monetary policy of the central bank. Oh, it must have been an act of God. Or maybe it's just winter and demand for ice cream's low. And I would say, well, if we have another hot summer, those ice cream prices are likely to go up. Oh, maybe I start buying in May, and by June, July, August, the value of ice cream will be much higher. Yeah. But the sad thing is, even experts don't seem to grasp the common sense. Yeah. Oh, I wouldn't go that far. I just want you to know reality so that you can make informed investing decisions. And, you know, people on TV sort of miss the common sense part. I can't imagine what, if you were listening to 5 or 6 or 10 other YouTube gurus, I can't imagine what they're saying. Yeah. I'd be careful where you get your information. Yeah. Cool. So anyways, is there more room to fall? Well, you need to make a decision. But the way I've taught you to trade is, these things come back, and anywhere in here is a sell. Okay. That's that. Richard says a disruptor in supply. Okay. Price, quantity. Okay. And this is demand. Okay. And we'll make this a different color. This is supply. Okay. Cool. So the equilibrium is here. Quantity 1 of ice cream. The price of ice cream when we're at equilibrium. So price 1, Q1, and we'll call this the ice cream market. Okay? Okay. Good. Okay. So we have a shortage, right? A shortage of ice cream. We'll call this Q2. Okay? Okay. S2 from S1. Okay? Okay? Actually, what we wanted there, I didn't quite draw it right. Actually, let's just do it right the first time. Okay. And it's more like here. Okay? So we've gone from price 1 to price 2. Because we went from equilibrium 1, quantity 1. But if there's a shortage, people are willing to pay more. Okay? So the price of ice cream went up because there's a shortage. Cool, right? How many people like this kind of stuff? Anybody like doing the supply and demand equations? Okay. Cool. What percentage of YouTube gurus that do your trading and investing live streams, what percentage are doing stuff like this? They can just show you. I don't know because I don't watch anybody else. What percentage is it? 50? Is it 20? Is it 10? Is it 80? Is this common knowledge? Right? Or is it somehow more rare? Okay. Demand. Okay. And so we have supply. Okay. Demand 1, and we'll leave supply as supply. All right. So the weather heats up, and it's becoming a beautiful year weather-wise. Okay. And the temperature starts to heat up. And we have an increase in demand. Okay. Trying to get that straight. Q2. Okay, that's the increase in demand. Demand went from quantity 1 to quantity 2. What happens to price? Price goes up from P1 to P2. Nice. Now, this is in the training course. Okay. And if you take a high school or university level intro to economics course, you will learn how to do this. So many of the courses, like I'd say the macroeconomic one, the oil one, the central banking one, like they're college, they're university level lectures. The courses are only like 15, 16, 17 hours long, but because we don't do any of the math and we don't do homework and all that kind of stuff, but they are quality. You know, university quality. Yeah. And it might help you frame models and to understand what's happening in the world and all that kind of stuff. Okay. Cool. So it comes down to like what time frames are you paying attention to? And you'll notice relationships in the techniques that I use where this is a daily 5 EMA. Okay, this is a 4-hour 21 EMA. You can just call it a 20. Okay, what's the relationship? Well, what is 20 divided by 4? We're on a 4-hour chart. If you had 4 times less candles, you would have the 5 EMA. So the way I've taught you is when you're on the 4-hour and you want to sell it off the daily 21, the 4-hour 21, you are selling it off the daily 5. And all I ever wanted you to do was sell it off the daily 5. And then you're like, wait, what? That's a 20. Okay. It's actually 21, but I did that later in life. So you're like, wait, so by analyzing one chart, you can see multiple time frames? Uh-huh. Yep. Whoa. That's nice, isn't it? Oh, for sure. Okay, cool. Nice. Nice. Let's do some commodities. Okay. Hey, oil crashed, but then found support at 72. Oh, well, that's shocking. You know what you hear all the time on TV? Oh, it's Iran said this and Israel said that and Biden fixed everything. And you're like, wait, well, maybe it's just the pivot points. Okay. Now, I'm looking at this price, and this price. So if there's a change, okay, I want to then maybe react then. So I'm going to look at this as a level. It'd be interesting is what happens if we have this over the next day or two. Okay. And I still think we'll probably come down and retest this, but I don't know. So you turn that and you hope for this. And once you make a higher high, higher low, so now that's more reality because it's not going to go straight up. So let me take all that out. Okay. And once you get to the higher high, then I jam my stop. And if it comes down and we have a double bottom of a double bottom, so be it. I'll try again. But it just might go up. And then, of course, geopolitical risk might just do like you're doing a nice little thing and it does this, and then all of a sudden it goes like that. Well, that's not technical. You couldn't plan on that. But I also know geopolitically it could happen. I don't think so, but I think it could happen. Now, is it a good time to do this? Okay, you think about the logic there. Is this a good time? When should I come in as an institutional investor and accumulate a position? Oh, well, for that, you might need some more data. So you're like, you log in, you're like, I'm going to pull up some data. I'm going to be smart about this. Okay. And August to September, yeah, it has some up. Look at this, guys. Once again, let me highlight. Okay, let me highlight to make sure everyone's following. This is the year of oil moves over the last 5 years. This is the year of oil, the shape of the oil market over 20 years. Does there seem to be a relationship? Are they somewhat similar? What's happened over the last 5 years, which is unusual, and what's happened over the last 20 years, which is accumulating the good, the bad, the ugly, the boom, the bust. It's all over the place. But are they reasonably similar? Yes or no? It's subjective. Bueller. Okay. So, people might have been surprised during this period. It shouldn't be surprising. Okay. People might have been surprised during this period. Well, they shouldn't be surprised. But also look at the normal recovery that time of year. And people are like, oh my God, oil's rallying. It's this, it's that, the other thing. Isn't it just normal? And so now what? Well, we know somewhere between September and October, oil tends to go up, to catch a bid. Will it happen this year? Oh, I don't know. But what's normal? Okay, look. Somewhere between July, August, and September, we bottom out on the pullback and work our way up. Now, if you want to see what weeks, okay, we can figure all that out. But I don't think you need to be that granular. So oil's falling right now. Cool. Should you buy it? Oh, I don't know. Is it supply and demand? Could be. Did you read the OPEC report? Did you read the EIA report? Are you in tune to geopolitical risk? What do you think is likely to happen over the next 2, 3, 4 months? Oh, you don't have an opinion? Then you can't do this. The reason we have all this data is so you can form an opinion based on data. Okay? But you can see there's some decline and then maybe some up, a reaccumulation. Okay? And it keeps going until about February. Huh. Is that going to happen this year? No way to tell. Is this year different? Every year is different. These are averages. But how would you like to trade oil and not know any of this? So, again, think of it. You use QuantBox, and it says, okay, let's take the average of the two averages. Okay? That's what's going to happen this year, because that's on average what happens every year. So should you be surprised about this? Should you be surprised about this? Should you be surprised about this? And if it goes up, should you be surprised? I don't think you should ever be surprised. I think you should be prepared, ready, willing, and able. So you can have TRADARS maybe do some technical analysis for you because you know it's sitting on support and you know seasonality just might wake up. And TRADAR says, oh, did you see oil is in an uptrend on a 15-minute chart? And that oil could go from this 73 as high as almost 76 today. That's just today. That's just the next leg of the pattern. What if it goes up for the 2 months, like seasonality suggests? Well, you'd be buying in around 73, and you're probably holding to 83, maybe 100. Geopolitical risk might kick in. All kinds of interesting things might kick in. Okay? Cool. We got some resistance emerging. That's not a great opportunity, but that's where this is. Okay. Obviously, you can see there's correlation between Brent and WTI. Well, that's good. Okay. What about longer term charts? Okay, longer term, you can see we've been in a bear run. Yeah. So now you have to make decisions. Are the short-term patterns reversing the longer-term ones? Yeah, well, okay. Ooh, look at that drop in gold, but we're still in a rising wedge. That's interesting. Anyways, so yeah, you get ready and prepared. Like I've already identified, I prefer higher lows. I don't need to be the first one in the trade. Okay. I can wait. I can wait my turn. It'll be fine. We know that it's falling. We know that. All we know is this is usually support. But this can fall forever. So this way you have to be a bull or a bear. And you're like, well, if I sell here, it's going to make a lower low. Yeah, true that. What I'm saying is, what if you were a bull, you based it on seasonality, you based it on the potential for geopolitical risk to just jump prices. Okay, great. So how would you set that up? That's your hypotheses. You can't be somewhere in the middle. Oh, I think it might go up, but it might go down. That's a fail. Pick one, flip a coin. So if this is going to reverse, it has to do a reversal pattern, doesn't it? It can't reverse without a reversal pattern. Please do the S&P 500 with 5-year and 20 years. Yeah, good. Why don't you just pay the money? Okay. For $80, you can do that for every asset there is. Yeah, not a problem. Quantbox.co. Easy peasy lemon squeezy. Okay, so your hypothesis is oil's fallen enough. This is support. That's why we have it there. So if it reverses, if you get a reversal pattern off of support, maybe it is a change in direction. Yeah. Now, you can be a bear. This is a warning, though. The green zone's a warning. But if you want to be a bear, it makes sense. It's a downtrend. So you sell there, and you probably get a lower low, lower high, lower low if you're going to continue. But even if you get the first leg down, you really now have to be aware of the potential of the reversal there. So the thing is, just be one or the other. You know your opportunities. You know your threats. You know how to manage the trade. But when you're wishy-washy somewhere in between and you're like, I only trade the stochastics. I'm like, dude, seriously? Oh, my God. Well, there's this guy on YouTube. He trades Forex on his phone using nothing but the stochastics, and he drives a Lamborghini. Oh, yeah. Yeah, that's great. That's really great. All right, so you see, pick one or another and use technical analysis to confirm or deny your hypotheses. Okay? So we are back into the testing ground here on the daily for gold. It's really struggling to make higher highs. Okay? Well, no. Is it inelastic? Well, here the concept of elasticity has to do with, your willingness to buy at any price, or or your sensitivity to the change in price, right? Well, if you were Saudi Arabia, you don't mind oil prices going up, right, Al? Because it's coming out of the ground for the same cost. So whether it's $75 a barrel or $90 a barrel, it still comes out of the ground for $3. Those costs are so fixed, right? Okay, cool. So it doesn't matter, right? Yeah, but the thing is, if it gets too expensive, you kill the economy, you kill your customer, and now nobody buys it because they don't need energy. Their economy's crashed. So from the consumer, well, the consumer would have to give up going to work or find another means of going to work. So they definitely will pay higher prices. Okay? Now, who controls the prices? The government will tell you, and our government here in the United States, that American oil companies are greedy and they're gouging Americans. If you take the oil trading course, you will understand that that's absolutely ridiculously stupid. It's so stupid. There's no factual grounds for that at all. So who jacks up oil prices? Saudi Arabia? Are they evil? Is it the Venezuelans? Is it Iran? You really need to understand the market. I have 16 hours of lectures that will help you understand the market to a very, very high degree. Yeah. So I think, to answer your question, I think everybody, producers and consumers of energy, are very sensitive to changes in price. Yep. All right, I'm done. If you're in my CIA, I'll see you at noon. If you're in my day trading group, I'll see you at 4. If you're in my swing trading group, I'll see you at 4. Peace on earth. May the pips be with you. May our profits be above average. Have a beaut. That just happened.